Price targets have come in for the S&P 500 at the end of the year, sitting somewhere between 6,500 to 7,100 points, and if we take a look at where it is as of today's date, that is roughly between a 10 to 20% gain. Now today we want to look at 5 growth stocks that do look to have a much larger upside than what the S&P is estimated, and the first one is Hims & Hers Health. Now for those that don't know, it is a telehealth company. They provide online consultations as well as direct-to-consumer wellness products. These include treatments for hair loss, mental health, skincare, as well as sexual health, and they aim to make healthcare more accessible and convenient through their digital platforms. If we take a look at how they've performed over the last year, they are up around 230%. Bear in mind, it is a very strong growth stock, but it is also very volatile depending on if they hit those earnings every single quarter. Right now, it is sitting at the upper end of the 52-week range, and whilst we only get one buy rating from Seeking Alpha, we do notice both Wall Street and Quant aren't far away from the 3.5 that would flip them both into the buy rating. Now we'll look at a lot of information for each one of these companies as well as our own valuation, what we believe the upside to be, but nice to see over the next 4 quarters, 3 of them they are expecting growth. In fact, the next 3 actually some very large triple digit and quadruple digit for the next quarter, with also 4 out of 4 beats, giving them a 100% track record in their accuracy for forecasts. But we do want to point out the earnings per share over the next full year is expected to drop very slightly, which does give them a forward P right now of 54. And we also want to take a look at some of their ratings. Now the first one is valuation at an F. No surprises here because when we do look at it on a forward-looking basis, it is trading higher than the sector median, meaning if you're buying this company right now, you are paying an 81% premium, something we do notice no matter which valuation metric you do look at. But as always, some companies do deserve to be trading at a premium. The question is how much, and that is what we want to get to. Nice to see the growth is an A, which does make us believe they do deserve a premium. Year-on-year growth as well as forward-looking in the mid-50s when the sector comparative sits around the 7%. We also like the fact that their free cash flow growth year-on-year is triple digits, 217%, again significantly higher than the 16% of the sector comparative, and their profitability also looks great at an A. Gross margin very high, 81%, higher than the sector of 58%. Bottom line looking good at 8%, whereas the sector median showing other companies actually losing money, -4%. And cash from operations also looks very positive, 187 million. As we said, sector as a whole is losing -15 mil. We also want to incorporate what the institutions are doing with around 64% ownership. Now we do notice more selling over the last year, 439 million versus the 374 million worth of buys in the same time frame. But what we do want to point out, in the most recent quarter, Q4, institutions are actually starting to buy more. In fact, nearly 3 times just in Q4. So a bullish sign, institutions maybe are starting to pick up on this company, and maybe we will see in 2025 more buys than we have seen selling. We also very quickly want to run through some of their underlying metrics. With the free cash flow, ideally we want to see consistent growth over the longer term, and whilst we don't get that, it is good to see that it has turned positive in 2023, a nice increase based on the trailing 12 month, and very positive to see on the next 12 months anticipated growth to $1.10. We can also see sales growth has consistently been very strong in the double digits since 2020 on a trailing 12 month at 57%, and from a numerical format they were reporting 30 million worth of sales in 2018. Now on a trailing 12 month that sits at 1.24 billion. We also very briefly want to point out they've done the opposite of what we like. They haven't returned excess cash through share buybacks. We've seen them dilute your position as a shareholder over the last few years. The one thing we would say though, over the longer term, if they do continue to do this, it won't be an issue if they can outperform the S&P, but definitely something we would say to keep an eye on. And the ROIC, one of our favorite metrics, 10% or more, give us faith management are able to effectively allocate their capital. As we can see, it's been negative, meaning they very likely didn't report a profit until the most recent period, where we do see this at 10%, and hopefully, like other metrics, we can see it continue to move in the upwards trajectory, and that is also reflected in the operating margin. We get positive on the trailing 12 month, as well as the free cash flow in 2023, as well as the trailing 12 month basis. Net debt to EBITDA, we always highlight this. It does give us a little bit of an overview of the balance sheet, and 0 in 23, 0 on a trailing 12 month, 0 over the next 12 months, tells us it won't even take them one day to pay off all of their debt net of cash on hand. So for him, the balance sheet at a quick look does look very strong. Now we're also going to jump into the valuation where we do get to around $39. Now this is derived from the DCF model. Now for this company, it is the first one. We will very briefly show you how we got to it. We have the free cash flow year on year. Now for 2024, we have used their trailing 12 month, which does show a very large increase from the previous year. In fact, the average growth at 93%, we've gone for 20 with the discount rate at 8, giving us the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get $39, which does indicate 44% upside. But remember, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for HIMS or any others. And full transparency, we will show you at 15%, $29, 8% upside. And for those that are a lot more optimistic, $52 at the 25% point, indicating 93% upside, a near double from the current value. So using the 20%, we don't stop there, as we always like to apply a margin of safety given those numbers are somewhat subjective. So at a 10% level, which we only use if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data, that means it's a buy up to around $35. Then we keep going till it's near the current trading price, and what we can see in today's episode, around $27, based on the growth of around 20% year on year, you are getting 30% MOS. And Wall Street, whilst they are near a buy rating, they see this at $35 at the end of 2025, upside of 30%, which is higher than the most optimistic S&P target of around 20%. And as always, do give us your thoughts as we go along today. Now, before we move to the next stock, just to let you know, we have released our latest free weekly article, which we drop one every single Monday morning to your inbox. We highlight severely undervalued stocks as well as what's gone in the market over the last few days. And if you click below, you can sign up, read straight away, where you'll gain instant access to 46 undervalued stocks for the month of January. Lots of information, the upside that Wall Street themselves see over the next year. And on top of that, you can grab another spreadsheet of 43 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to NU Bank, which is a digital banking platform offering financial services like no-fee credit cards, personal loans, and saving accounts. And they aim to simplify banking with user-friendly mobile apps as well as transparent solutions all across Latin America. And if we look at the company, it is up 23% over the last 12 months, trading in the mid to lower end of the 52-week range, with a double buy from Seeking Alpha as well as Wall Street. And if we look at their earnings, great to see over the next 4 quarters, they are anticipating double-digit growth year on year to the EPS, with the last 4 at a bare minimum being in line. And if we look right now, based on their 2025 EPS, the forward PE currently sits at just under 20. Regardless, we do in fact see a D on the valuation, and even though we do believe this to be around 20 as we've just shown you, it still reflects here that the sector median is a lot lower, and for this company you are paying a significant premium. Again, that is also highlighted on the other valuation metrics. If we look at growth though, it does look very strong, 74% on a historical basis, 49% looking forwards, well above the mid-single digit of the sector. And we can also see the earnings per share on a diluted basis. The growth does look to be extremely high at 372%. Profitability also looks good, 100% gross margin, sector at 59%, bottom line 33%, sector at 22%. And we also like the fact the cash from operations, $3.7 billion, with a comparative at $138 million. Institutional ownership fairly high as well at 84%, with around $4 billion worth of sales. However, we get nearly double the amount of buys, and on top of that, in the most recent quarter, institutions have been buying a significant amount more. So there is no confusion for NU Bank. Institutions are very, very bullish. In terms of the metrics, well, free cash flow a little bit inconsistent, but it has been increasing over the last few years. Sales growth looking very good, in fact nearly triple digit growth year on year. We do note that for 4 of the last 5 years, and then we can see from a numerical basis the very rapid increase. We also notice the dilution of shares as the years have gone by, and when we look at return on equity, we do like the fact that we get 18% in 2023 and 26% on a trailing 12 month. In terms of the valuation, we do get an intrinsic value of just over $15, and when we do apply a margin of safety today, it does look fairly strong as well. You are getting around a 25% at the current point, with Wall Street very bullish. They in fact see 55% upside right now to the end of the year. Their price target is $17.40. We then move on to UiPath, which is a software company specializing in robotic process automation, RPA, enabling businesses to automate repetitive tasks and workflows, focusing on improving efficiency and productivity through AI-powered automation tools. Now, looking at the company, they are down around 40% over the last year, currently trading at the lower end of the 52-week range with just a buy signal from Seeking Alpha. And if we do take a look at their earnings, out of the next 4 quarters, they are expecting 2 of them to be growth, and we do like the 100% historical accuracy, with the January 2026 EPS estimate giving them a current forward P of 26.3. In terms of the valuation grade, they do get a B. We can see it isn't far off the sector median, so you could argue pretty much in line, a very minimal premium. But as we can see, actually, if you do look at other metrics, then we can in fact note a slightly larger premium. In terms of the growth, A-, again looking better, 16% year on year, 14 on a forward-looking basis, mid-single digit for the sector on both accounts, and we do like the fact the earnings per share is anticipated to grow at 33% with a comparative at 15.4. We also like the profitability at an A-, 83% gross margin versus 51. Bottom line is negative though. This is something to be wary of with the sector median at 3.8, but regardless, they are still generating cash from operations, 320 million versus 98.2. In terms of what the institutions are doing, ownership at 62%, we do in fact notice they were selling a lot more over the last 12 months, 1.3 billion versus 831 million. But again, similarly to other companies, in Q4, they have started to ramp up their buyings with significantly more than they have been selling, 2.26 million versus 709,000. In terms of the metrics, again, it has started to look better over the last few years, and we do anticipate this to continue, especially with the way AI is starting to really ramp up this market. In terms of sales growth, whilst it has started to slow down, we are still getting double-digit revenue increases, and on a trailing 12 month, this does sit at 17%. In terms of the shares outstanding, well, we do also note the continuation of share dilution on the stocks we have seen today. But remember what we have said, if they can outperform the S&P, then it is less of a worry. However, this isn't something they have been able to do so far with consistency. ROIC, not looking great, but it is improving over the longer term, right now sitting at -9%, and the same does go for the operating margin, where we see -12%. The positive to take, though, the free cash flow is looking very strong at 22%, but one thing we do want to note is the consistency. Speaking on a more positive tone, the net debt to EBITDA 0 over the last 3 years and anticipated over the next 12. So overall, the balance sheet does look very strong. It won't take them one day to pay off all of their debt net of cash on hand. Now, our intrinsic value at $17, when we do put it through the margin of safety, we can in fact see you're getting at least 20%, with Wall Street themselves upside of 28% at the end of 2025. They see this sitting bang on $17, and as always, do give us your thoughts below. We then move on to Grab, which is a super app offering services like ride-hailing, food delivery, and digital payments across Southeast Asia, and they aim to simplify daily life by integrating transportation, financial services, as well as logistics, all onto one platform. In terms of how they performed, well, over the last year, they are up 44%. They are trading in the midpoint of the 52-week range. We get a strong buy rating from Quant, a double buy from Seeking Alpha and Wall Street, although in fact, Wall Street not far off the 4.5 to turn this into a strong buy. And if we do look at their next quarter they are to report, they're anticipating 96% growth EPS on a year-on-year comparative, and they are expecting the earnings per share to turn positive at the end of the year, which does give them a very high forward P at 90.1. If we compare that, we do note they get a C+ valuation, but pretty much on every valuation metric, it does look very, very expensive. You are paying a premium, but as we always say, sometimes companies do deserve the premium. In terms of whether or not they deserve it, well, an A+ on growth, which is very good, 22% year on year, 33% moving forwards, with the comparative for the sector sitting in the mid-single digit point. Very good to see, though, the free cash flow, very large growth over the last year, 571% versus 6.1. In terms of profitability, also looking good at an A. Gross margin 42% versus 32%. Bottom line, though, it is negative, something to be wary of, with the sector at 6.5. that we do like the fact they are generating cash from their operations, 573 million versus 349. In terms of institutions, well, 55.5% ownership, around 540 million worth of sales over the last year. We get pretty much double that or slightly above that over the same time frame, but we also notice in Q4 pretty much the institutions were just buying 54 million with only around 37,000 of sales. In terms of the metrics, we're always good to see going from negative to positive in quite a consistent manner. This is typically where we do see a lot of the benefits of buying growth companies if you do believe in them over the longer term. And the sales growth also looks very, very good. You could justify 2020 during to be COVID, which would massively affect this company and their sales. 22% though is noted on a trailing 12 month, where we can in fact see the numerical basis, 470 million in 2020, 2.4 billion in 2023. And again, following the trend today, they have essentially diluted your position as a shareholder over the last few years. ROIC, it is getting smaller in terms of the negative number, so hopefully over the next year or two, we can see this turn positive. And the estimation of the earnings per share to turn positive in 2025 is a good indicator. We will start to see them turn a profit. Operating margin and free cash flow margin, they are struggling, but good to see 18% on a trailing 12 month. With the net debt to EBITDA, again, yes, companies do have issues, but it does give us a bit more faith when we do see a fairly strong balance sheet, 0 on a trailing 12 month, as well as 0 over the next 12 months. And the valuation itself, which is always important, does give us a nice margin of safety today. As we do keep going, we can pretty much see a 25% MOS, with Wall Street themselves indicating 27% upside, a $5.70 price target. We then move on to Toast, which is a cloud-based platform that provides restaurants with point-of-sale systems, payment processing, and management tools. They help streamline operations, enhance customer experiences, and improve efficiency in the food service industry. If we take a look at their performance, well, over the last year, up 113%, they are trading in the upper end of the 52-week range with a strong buy from Quant, a double buy from both Seeking Alpha as well as Wall Street, and we can in fact notice out of the next few quarters, they are anticipating some very large growth. However, we do need to flag that over the last 4, they have, although marginally, missed analyst targets. So what are they anticipating? 89 cents for 2025, which does currently give their forward P around 41.3. Now the valuation is an A- here. However, if we look at a P on a non-GAAP, they are trading significantly higher, so that is nearly a 400% premium. But for those that do want to look at the PEG on a non-GAAP, 0.13, well below the 1.37, which does mean you are getting a very strong discount, and that does drive that A- valuation. Growth looking good at an A+, pretty much 30% year on year as well as forward looking, much better than the mid-single digit for the sector comparative, and they are expecting some rapid growth, 467% year on year over the next 3 to 5 years on the EPS, with the comparative for the sector at 10.3. Profitability at a B-, 23%, which is a lot lower than the sector of 60. Bottom line, a very marginal negative 1% versus the sector at 22. And we also notice they do generate cash around 305 million with the comparative at 138. Institutions themselves, 83% ownership, 711 million worth of sales, 2.2 billion worth of buys. However, we do have to point out, whilst they've been buying more over the last year, over the most recent quarter, they actually sold more. In terms of the metrics, nice to see positive in 2023 and the upward trend on the trailing 12 month as well as anticipated over the next 12. Also good to see the growth they have been having, although again, many things you do need to question with growth companies in general is when do you believe that growth story will end, or are they just at the beginning or the midpoint? And pretty much all 5 in today's episode have been diluting your position over the longer term. Now ROIC, it is getting smaller, negative 2% on a trailing 12 month, so we do anticipate to see a profit very soon, especially when we can see on the operating margin, negative 1% on a trailing 12 month. Nice to see though the free cash flow over the last year and on a trailing 12 month to be positive. We do ideally want to see a minimum 5%. And again, pretty much following all of the companies today, they have a very strong balance sheet. It won't even take them one day to pay off all of their debt net of cash on hand. In terms of margin of safety, as we do keep going today, we don't in fact get a very large one in comparison to others. However, you are getting at least the 10%, around $38, but you could argue sitting somewhere between 10 to 15, will depend, as always, how much you want for each one of these companies. Wall Street themselves, though, have a $45 price target. They see 22% over the next 12 months. And as always, do give us your thoughts in the comments below. And don't forget to sign up to the free weekly newsletter. We are dropping a new copy Monday morning, and grab those spreadsheets, as well as coming and joining us in the Patreon, where we do cover our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.